Ladies and gentlemen, welcome to Fontobel. My name is Yassine Benhamida, and I'm very pleased to welcome you to our live stream today. Today, we have selected a very special topic, BRC, Barrier Reverse Convertible versus direct investment. What is best? What's the best time to use one or the other type of investment? I'm very happy to welcome today our speaker, Roxana Kazakou. I will introduce her in a few seconds. But just before, I would like to explain you how the session will work. Roxana will go across a few slides to explain a bit the background of BRC and direct investment. And at the same time, you are able to ask your questions. So on the right side of your screen, you see a chat box in which you can send your questions. I will receive them here directly on my screen, and I will be able to ask them to Roxana at the end of the short presentation. It's a pleasure to welcome Roxana. Roxana is working in the Structured Products Department for the last 3 years at Fontobel, and she will be holding this speech in English. She's part of the dairy trade team in Zurich, and I'm very pleased to welcome her. Roxana, the floor is yours.
Thank you, Yassine, and thank you to everyone who is joining us on this live stream today. Our topic is around the barrier reverse convertible, when it makes sense compared to a direct investment in a share. So I'd like to start off by looking at the risk and performance profile of both a direct investment and a structured product in the form of a BRC. So if you look at a direct investment, what we really notice is that we are obviously buying a stock. So on the upside, as benefit, we have the full participation of that stock in the form of capital appreciation. On this flip side, of course, we're fully exposed on the downside. So if we really look at a share, that's what we see. On the other side, when we look at structured products in the form of BRC, we see that on the positive side, we have a coupon which is guaranteed. This coupon, however, is limited because it's a fixed payment. On the flip side, the risk, of course, is that once the barrier is hit in the BRC, we are fully exposed to the depreciating underlying. If we take a closer look at the BRC, like we said before, I'd like just to point out some of the opportunities that we can have with the BRC. So the biggest advantage that we have is that we have a fixed coupon. This fixed coupon represents the yield that we have on the product, and this can be paid either in quarterly, in yearly, or in semi-yearly arrays. What is also good about the BRC is that it's a product which is very well suitable in sideways moving markets. That means that the market doesn't necessarily have to go up a lot. It could go down, and we could still get 100% of our invested capital plus benefit from the yield. As long as the barrier is not breached, we can also recover all of the capital that we've invested. Of course, we have risks, like with any kind of financial product. We have the risk of the issuer, we have market risk, we have currency risks, and once we have hit the barrier, we're fully exposed on the downside. To illustrate a little bit more clearly what we're talking about, we're taking an example of a BRC. This BRC has an investment amount of 50,000 with a barrier of 80, a strike of 100 for 1 year. And with this BRC, we really want to see what the different scenarios are. In other words, what happens to this BRC in the repayment scenario when we compare it to having bought the actual stock. This is what we will do. So we have one scenario where the stock is really benefiting from capital appreciation, another scenario where the stock is moving sideways, and the last scenario where it's basically going down.
Thank you, Roxana. So let's take the first scenario, rising share prices without touching reaching the barrier? How does it look like?
Yeah, so basically, if we take having bought the stock originally, we would benefit, of course, from the capital appreciation. So if we have a stock, like in this example, the stock is ending at 110, we are benefiting from the direct investment of this whole appreciation. So having gone from 100 to 110 for our investment amount of 50,000 Swiss francs, that gives us a higher repayment scenario than the BRC. Why is that? Because the BRC is limited. The BRC has a coupon, and this coupon is fixed. This means even if the share price would go up above the yield of this coupon, we are still limited in yield to that coupon. So to illustrate it more clearly, in our example of 50,000 Swiss francs, as long as the barrier hasn't touched, which it hasn't, we're getting 50,000 back, plus the coupon of 2,500 francs, 52,500 francs. On the direct side, had we bought the stock, we would, of course, participate from the entire uprise in the stock price. So we would get a full participation, meaning we'd have a higher payout scenario of 55,000 Swiss francs.
Thank you. Let's go to the next scenario, scenario number 2, sideways trending share price without reaching the barrier.
So this is also very interesting because the market is moving sideways. We really want to illustrate that a BRC is the optimal product for markets that are sideways moving. And this is really why. Had we bought the stock and had this market been moving sideways, downwards, in a realistic scenario, as long as the share price closes below 100, we are incurring a loss. In other words, our investment of 50,000 is no longer 50,000. It's now has a loss. So we're ending at 45,000. On the flip side, if we look at the BRC, because we haven't touched the barrier, we are still getting 100% of the invested capital back, plus the yield. The yield of the coupon, 5%, out of 50,000 Swiss francs, makes 2,500 Swiss francs. So our repayment of 52,500 Swiss francs is much higher than the repayment with the direct investment.
So let's take the third scenario, a rising share price combined with touching the barrier.
So once again, very interesting scenario. This also shows a scenario where the barrier is actually being breached, but the underlying manages to recover back to the original strike. In our example, the strike is at 100. We can see in the chart below that the underlying touches the barrier. However, at the very close or at final fixing, it manages to recover above the strike. This recovery means that I'm able to get all the invested capital back, 50,000 francs, plus the yield, 2,500 francs. On the other side, had I bought the stock in this case has closed above 100, so it's closed at 103. Clearly, I have a gain from 100 to 103. Calculated for the 50,000 francs, I've gained 1,500 francs. So at the end, I have a payout of 51,500. The payout in this case for the direct investment in the share is actually lower than the fixed coupon that I'm getting from the BRC. This third example, together with the second example, illustrates how a BRC can be a great product in sideways moving markets because it really suits this kind of market possibility.
Thank you, Roxana. Let's take the fourth scenario, falling share prices combined with touching the barrier.
So obviously, this is a scenario that is not so likely, let's say, but it happens and it can happen. It's a bit of a lose-lose scenario, of course, because the barrier is being reached. So in both cases, I'm making a loss. Let's take the direct share. So if I'm buying the direct share, I've closed below 100. It's clear I've incurred that loss. I'm getting a payout of 42,500. So you can see the loss there. 7,500 Swiss francs. On the flip side, of course, if I choose to take stocks with the BRC as a settlement type or cash, at the end of the day, I can explain what the difference is, but I still have that loss. Ultimately, the only difference or benefit is that with the BRC, I still have the coupon. So the coupon, in a way, is helping me compensate for some of the loss that I have as a result of the stock having closed below 100. In our calculation, I have, of course, the shares if I choose to take physical delivery. That way, I am not monetizing this loss immediately, but I can still hope that if I get the shares in my portfolio, they might still recover. Plus, whatever is left, I get in cash. Or I just have the cash payment that includes the coupon as well. So the scenario in number 4 shows that even if the barrier touches and it doesn't manage to recover back, as a BRC, I still have less of a loss than I would under a direct investment.
Thank you, Roxana. So what conclusion can we draw out of these 4 scenarios that we looked at?
The conclusion that we can draw is that BRC or a direct investment, or for that matter, any kind of investment solution, can make sense depending on the risk profile of an investor, as well as the expectations that we have of an underlying and how that underlying will perform, or what our conviction is on that underlying. If we have this, we can build up any structure that we think in order to mirror that opinion that we have of the underlying. With a structured product or with a BRC in this example, we're able to manage the risk by using parameters such as the barrier observation, the strike, in order to make it more or less risky. We're also able to benefit from stocks that might move sideways in case we want to have a fixed coupon and we don't want to take all of the risk that we have with a direct investment.
Thank you, Roxana. Thank you for these very clear statements. I think we understood the benefits and the risks associated to these 2 types of investments. Let's go to your questions. It's your time, so if you have questions, please send them through the system. We'll be happy to answer them. I'll take a first question. Roxana, a typical question about options and structured products. What is more commonly traded? Is it American or European options?
So the most commonly traded that we see in Switzerland for our dairy trade platform are BRC structures with an American observation. Of course, an American observation means that we have continuous observation of the barrier. It bears more risk, but as a result, it also bears more return. What we also see is that the majority of clients taking American observation are carefully selecting their stocks because you are very exposed, of course. What we also have is the European observation, of course, that's at final fixing. Takes away from the yield significantly, but it also bears a lot less risk because obviously the barrier observation is only at the final fixing.
Thank you. We have received another question with regard to correlation. So what role does correlation play on a basket of stocks, if we have a basket of stocks, in terms of the performance and the risk? Could you give a bit of information on that, please?
Yeah, so if we have a basket of stocks, the more underlyings we have in the basket, the higher the risk associated with this basket. So that's the number one thing. So BRC on various underlyings will always bear more risk than a BRC on a single underlying because the probability that a barrier will be touched is higher, of course. Then we also have to look at what the relationship is between the underlyings in the basket. So if we have underlyings that are moving together, such as underlyings within the same sector, these underlyings have a positive correlation. then the risk is less than if we have a basket with underlyings that are not moving together, so more of a negative correlation, because the basket with the underlyings that are not moving together have a higher risk. There's more probability that one of them will hit the barrier since they're not really moving together. So that's the short explanation.
Thank you, Roxana. A question we just received is about the worst case scenario that you mentioned before. So in the case we receive the underlying, when we're talking about BRC with basket of shares, which share are we getting and how does this exactly work?
Yeah, so when we have a basket of share, especially with the volatile markets that we've had in the last couple of weeks, we've had a lot of barriers that have been touched. And what's important to know is that within a basket, you can have 1 or 2 underlyings being touched, maybe even 3. But the repayment will always be on the worst performing underlying. So in other words, the scenario will always pay back the shares of only one of the underlyings in the basket, and it will always be the underlying with the worst performance.
Thank you, Roxana. Maybe a question which is of interest to our viewers about the physical settlement versus the cash settlement. Could you explain this to the audience, please?
Yeah, so when we have the cash settlement, obviously the physical settlement only happens in the case of a barrier breach. So that's really the only time that you will get back any kind of physical settlement. So here we distinguish between the central question, which is, if a barrier is breached and you're getting the repayment scenario, do you want to monetize this loss immediately or not? If you want to, or you're ready to monetize the loss immediately, then you will choose the cash selection. That means that you're getting cash back, of course, with a loss. If, on the other hand, you say, I am taking the loss, but I don't want to monetize this loss because I want to wait and see if the shares might still recover at a later point, then it makes more sense to take the shares, which means physical delivery.
Thank you. Roxana, a question about the dividends. What happens to dividends of the underlying into a BRC? How does this work?
So one of the advantages that you have if you invest, of course, in the single stock is that you're benefiting from the dividend payment. This is a clear advantage of shares, that on the BRC side, the dividends are calculated in. So they are already embedded in the price and reflected in that coupon. But of course, you're not getting them paid out.
Thank you, quite clear. A question we just received about the length of a BRC. Does it make sense to have a shorter tenor or a longer tenor?
So this is depends. It depends on their underlying. So one of the things that we see is that, for example, now when the volatility is quite high on the short term, that means that the yield tends to be a little bit higher on the short term. And of course, it doesn't just depend on the market situation, it also depends on the particular stock. So we wouldn't say there's a clear tenor that we recommend. It all depends on the stock. But what is important to mention is that it could be that your client knows exactly what underlying they want. And then by simulating and doing all these price requests, you can see if a tenor of 9 months can make more sense compared to a tenor of 12 months or compared to one of 6 months.
Thank you, Roxana. We're getting a question about strike. Does it make sense to adapt the strike or always to start from a basis of 100?
Yeah, again, it depends a little bit on your scenario. So if we leave the strike at 100, basically, it means that once the share has hit the barrier, it needs to recover back to the strike. If we adjust that strike down let's say the barrier is at 50 and the strike is at 100, if it touches 50, it needs to recover all the way back to 100. If we bring the strike down and we say we put it at 80, if it were to touch the barrier, it no longer needs to recover back to 100, it only needs to recover back to 80. So this recovery is a little bit smaller. Therefore, the yield is also less.
Thank you, Roxana. I think I'll take 2 more questions from the audience. Thank you for your participation. The first one I would like to take on is, we faced a corona crisis, we faced this very special situation. Right now in the current environment, is it better to go for direct investment or to go for BRC? What's your opinion on that?
Yeah, it's a difficult question.
It is.
I think there's no right answer, but I think the volatility is obviously very high. So the volatility is high, but on the other hand, you have to really have the courage to say, okay, I'm doing a structured product now. Because obviously there are a lot of unknown factors in the market. Things are not reacting logically. The market is kind of being upheld by all the money that is pumped into the economy. So you could say that it's not really real. I think personally, because the volatility is so high and it's so difficult to predict, what we've seen is a lot of BRCs or a lot of structured products with low barriers, because in this time you can really afford to take a barrier of 50. It still pays enough. Even barriers at expiry, which usually are very conservative, don't pay that well, but during this market time they really do. And maybe for a period of time that's not necessarily 2 months or 3 months, because it's highly, highly volatile and unknown, but maybe something like a year or 6 months. It really depends on what your expectation is regarding when things will stabilize, depending on a vaccine, the probability around that, and how markets will react.
Thank you, Roxana. Maybe a last question about the secondary market. We're getting a few questions about that. People are asking, why is that so that in the secondary market, am I only getting a bid price?
Yeah, so this is quite common actually. So with the issuers that we have on the dairy trade platform, we are always legally bound to guarantee a bid price. This means for your client that they are able to sell at any point that they want, and that's our responsibility. But not every client is willing, let's say, to offer an ask on every single product. So it could be because they don't have any more appetite, it could be because it's already getting close to maturity, or it could be because they just fundamentally don't do that. So that's it, really.
Thank you, Roxana. Thank you, everyone, for your participation. Thank you for the questions sent. It's always great to have this interaction possibility with all of you. Today we learned that based on your expectations on market scenarios, we should choose one or the other type of investment solution. If you have questions, if you want to continue the discussion, Roxana and her colleagues in Zurich from the dairy trade team are obviously at your disposal. It was a pleasure to have you today, Roxana.
Thank you.
Thank you, and we wish you a very good weekend.